Good evening, folks. It's Hari Swaminathan. I wanted to give a brief update on our trades. As we know, we did a couple of trades today, the Herbalife, the Goldman Sachs, and we also have open trades on Facebook and Google and all of that. So let's get started. I want to look at the Facebook first, right here. You see, Facebook went up about $1.50 today. So as you can see, short call at the 37 level lost a little bit of money, but a long call made up for it, and that's exactly the point because we have a delta of plus 552. So as long as we have this positive delta, we can ride the Facebook wave upward. So even though your short call will be losing money, your long call is going to make it up for it because of the delta differential between the long and the short. And that's exactly what you see. The profit and loss for the day is 825. So we're going to ride it some more because I think Facebook has an opportunity to go to about 37, 38. And like I said, as long as you have a positive delta, this trade will work. So that's as far as Facebook is concerned. FedEx didn't do much today. We were on the flat line, so let's not worry about FedEx. Let's look at Google. We'll come back to that. Goldman Sachs went down a little bit, a couple of bucks. That's fine. Bull put is at 150, 145. A couple of Trading Ideas subscribers put it at the 145, 140. That's very good. They went a little bit safer. That's perfectly fine. But as it stands, Goldman Sachs is still at 163, so we really don't have anything to worry about over here. Herbalife, we were expecting a move of 7, and as you can see, the move that kind of a move has not happened. It's up about 559. So tomorrow, what's going to happen is our 67.5 call is going to do well. It's probably going to go up to maybe $5-6. However, our 52.5 put is going to lose some money. Now, because we did not get the move that we were expecting, and frankly, I wasn't 100% sure. I thought a move might happen, but obviously we weren't. That's why we went out to 53 days. So remember, even though this is an earnings play, this is no different from any other trade that we'll put on because we've given ourselves 53 days to this trade. So there are many things that we can do tomorrow. Obviously, our calls are going to be doing well. So we can we'll see if it's if this kind of a move is enough to overcome the losses from the puts. My sense is it won't be. So we'll need to do something to the puts. But certainly there are many things we can do. So because we have 53 days, and that's precisely why we went out to 53 days. So I got a couple of emails asking whether we do anything with Herbalife first thing in the morning. No, we don't. We absolutely don't. We have plenty of time to work this trade. Okay, so Priceline. Now, what Priceline is doing is today it went down by about 12 bucks. So it came down to 888. Now we can see our bear put, which would be the 880, 860. You can see that is profitable. So I'm talking about this one and this one. I'm sorry, this one and this one. Oh, I cannot select two over here. But basically the 860, 880. The 860 is up 1950. The 880 is down 1250. So what we want to do is to try to get out of this trade. So tomorrow, what I'm going to do is see how Priceline opens. But what we may want to do is try to get out of this trade. But we are still down about 500 bucks, which is not a whole lot. Given that Priceline's earnings are coming up in about a week or so, we're not in a hurry to close the Priceline trade today or tomorrow. But I think before earnings we should take it off, especially because this trade was put about 2 or 3 weeks ago, and at that time we did not have the earnings cycle in mind when we put the trade on. So now the trades that we are going to be looking at is Herbalife and Google for tomorrow. And Google, let's see, Google went down to 882. So I want to actually analyze Google, and this is where we stand. So, after Google started going down, we put the bear call, which was, the 40 bear calls at the 950, 960 level. And now what's happening is our bull call is going to be losing money. But our bear calls should be making money. Let me see the monitor again. Bear calls are making money, not a whole lot, a couple of $100, but a bull call is losing, I would say, about 1800 bucks, which is what it was losing when we first made this adjustment. So that's down about 1800 bucks. Now, if Google continues to go down, then we need to set a mental marker for where we want to adjust Google. So because we have our bear calls at 950, 960. So if Google, let's say Google goes down to 875, okay, that would be $75 away from our bear call, which is a very decent distance away, given that we have only 53 days. So if Google goes down to 875, then what we want to do is, I'm going to take this one off the simulation. Then what we want to do is we'll close out these the bull call and open a bull put. So which means we would be turning this into an iron condor. So what I mean is, let's say, okay, so we decide that all right, between the on the bull call we have a loss of approximately 1800, we said, okay, and let's say it went down to 875. So the bull call will lose some more. Let's say, just for calculation purposes, it loses $2,000. So we are down $2,000 on the bull call. Now what we would do is, because we have this bear call at the 950, 960 level, we would want to construct a bull put so that we can convert this into a iron condor. So the way we would do that is, let's take these off, assuming that we are going to close it. Then we would come here, and if it's at 875, let's say we would want to go to approximately the let's say 810 vertical, 810, 800. So we would sell the 810 and buy the 800, and let's go to the same 40. Okay, so when we sell 40 of this at $1.10, actually this will be more, because when Google goes down to 875, you'll probably get about $1.25 or $1.30 for this. But let's just say it's $1.10. By selling 40 of these, we're going to pick up $4,000 in credit. All right. So on the 920, 930, we're going to lose 2,000. But on the 40, 810, 800s, we're going to pick up 4,000. So not only are we making up the loss, we are going to give ourselves the potential to make up an additional 2,000. So now when you look at it, this is a perfect iron condor. All right. So and that's what we would be adjusting it into. So we had a bull call, we would close that and turn this into an iron condor. So once we turn this into an iron condor, as long as Google is between 952 and 807, that's a huge range. As long as Google expires anywhere between these two levels, our maximum profit on this trade is going to be 9,200. However, we would have given up 2,000 on the bull call, so totally we'll end up making 7,200. So that's the adjustment I'm thinking of for Google. Herbalife, we don't do anything. Just let's see how things open up tomorrow morning, and we have plenty of time for Herbalife. So I will be sending out the alerts on that. Now, I do want to touch upon a couple of points, because today a lot of subscribers sent me many emails. So I do want to touch upon that. There is one, I'm just going to pause this video and bring up those emails, and I'll come back again. Okay, so one subscriber says, when you say $4.50 in risk, what do you mean? Are you saying that you must go out of the trade when your put option value is $4.50? Then another customer has sent in a question saying, in the Goldman Sachs bull put, what will be the total loss for 30 contracts if the trade will go down by so many points? And then the question continues, this is a credit spread, so you paid margin, right? Or if it is a debit spread, do you still need to pay margin? All right. Next question was, how does one get filled on this order? I don't quite understand what price gets filled, because when I placed the order, the price was for the spread was 6.43, but I've seen it working from 6.42 to 6.47 and so on and so forth. And then the next subscriber says, have placed this trade. How in general can I work out my total risk amount if the trade went against me completely? And then again, another person says, what trades are you actually putting on and how do we calculate the risk and reward? So my sense is, I'm not trying to single out anybody or anything, but I want to touch upon an important point here. There's a couple of important points by reading out these emails. Is what I want to say is that I know many subscribers have just joined, and many people may or may not have the right kind of foundational education on options. And I must say this because I'm not trying to scare you or anything, but if you don't have the foundation in terms of the education, options trading is going to be a very tough endeavor for you, because options are not like other instruments like stocks or futures where you can simply get an alert from someone and you put the trade. Options require you to understand a lot of these things. So there is a base element of education that is extremely important when it comes to options. And it's just not a good way to, if you're simply following my alerts and putting the trade on, it's not a good way to trade. I can tell you that right away. So, luckily all these people have been placing these trades on paper money, which I made sure I replied to all of you and told you that, which is good. It's fine. You can put it on paper money and check out how the risk and reward materializes and all of that. But that's not enough. What you really need is the education. And so I want to make that point very clear, because you're going to lose money if you don't understand what you're doing. And with options, it's as long as you have a foundational knowledge, then it's okay to follow a trading alert or a trading service. But if you don't have any knowledge, if you don't even know whether it's a debit spread or a credit spread, then there is a serious problem here, and you have to fill those gaps before you get into the trades. So, that's the one last point I was going to make. I just want to show also one more thing in case people want to get educated on options. I know you've probably been to Optiontiger.com. I have 47 courses now. Those 47 courses takes you from beginner to advanced, but you don't have to get that. There is a very attractive 5-course module. You can pick and choose your courses. Also, in my emails, you'll find my Udemy page. You can go to Udemy and look at the courses that are available there. I'm not trying to sell you anything. I'm just trying to give you advice that with options, it's different. You need to have the background education. And if you don't have that, following a trade alert or a service is not going to be, first of all, you will run into problems if you're just going to follow the trades blindly. And that's just not a good way to trade. So please feel free to put all your trades on paper money. That's fine. But at the same time, while you're on the service for the first month, perhaps you also want to look at how you can get yourself how you can get the gaps filled in, because that's very important. All right, that's it, folks. I'll speak to you tomorrow morning, and we'll be looking at our Herbalife and Google trades for tomorrow. Thanks. Bye-bye.